Past week we saw the market basically trade within a fairly stable range, and that was likely due to the fact that you had option expiration on Friday. Next week I expect that volatility is really going to ramp up, and if we just remember where we last left off, we had saw that big sharp decline on that Friday, October 10th. We got that big rebound as we expected on Monday. Following that sharp rebound, I had noted that implied volatility levels were fairly high in the VIX one day, and it was likely to come down. And we did see that happen. And then, of course, we got sucked into option expiration, and we saw the index really get pinned in this 6650 region. Now, next week, I think that volatility is really going to start expanding because we're past opex, and those pinning flows and those supportive gamma levels are going to be gone. And we're going to see gamma actually greatly reduced, and in the SPY is actually deeply negative. And that's going to really create a more volatile trading environment, and potentially one where we actually start maybe seeing the next leg of the market down. Again, but before we get too far into that, I just want to remind everyone, please remember to subscribe to this channel, like this video, share with your friends, and also remember I have a member area where I post videos like these every day for members in that area. And so when we kind of just flip back, one of the reasons why I'm thinking that, we could see volatility really expand this week is that when we look at where gamma positioning is, and we include all the expiration date, this is from option charts website, you can see that gamma is very low at just 193 million per 1% move. That's a very low number. Basically, we're at zero. Basically, the split between positive and negative gamma is basically even at this point. But when you look at the SPY and you look at all expiration dates, you can see the gamma nearly 3.6 billion per 1% move. And so that's much more negative than what you're seeing in the SPX. And so that's why I tend to think that we're more in a negative gamma regime coming into next week. And that means that market maker flows are really going to go with the direction of the market. And it also means that volatility is going to really expand and probably pick up intraday. And again, we started to see some really strange things happening in the VIX actually this week, where we really started to see it rise rather notably. And so again, there's some nervousness going into the marketplace, and it could very well be that the market is preparing for a post-opex environment. Additionally, we will get VIX opex on this Wednesday. And so that's going to also allow the VIX to start moving more freely once we get past Wednesday. And that's going to be another thing that we're going to have to worry about. So from a volatility standpoint, there's a lot of reasons to think that going into this week, we could see a lot more volatility going forward. More recently, we've seen the top of book in the S&P 500 really decline sharply. And so if we kind of just zoom out here and get a little bit more time under our belt, you can see that this is a fairly low reading of overall market liquidity, and it actually dropped further on the 16th. What this is telling us right now is that top of book is very thin, and that's going to also amplify the moves we're seeing in the marketplace potentially. So we're going into a week where volatility is likely to expand, gamma levels are greatly reduced, even negative, and liquidity levels are low, and they could actually go lower. And so that's going to create a lot more intraday movements, and it really sets up the potential for things to get a little bit more interesting as we go into maybe the middle as we start heading into November. And what's really interesting from the liquidity standpoint is what's happening really in the overnight funding market. We talk about that a little bit every once in a while here, but if you notice SOFR, which is the secured overnight funding rate, you can see that jumped up to 4.3% on Thursday. We'll have to see where the Friday numbers come in Monday morning, but my guess is they're a little bit lower just because I think there was some relief in the overnight funding market on Friday, which is probably also why you got a little bit of a rally. But you can actually see that the SOFR rate right now is at 4.3%, and that's actually higher than where we were when the Fed had rates 25 basis points higher. So it's an interesting dynamic because in this period of time here where things were fairly calm and they were still getting more volatile, the Fed hadn't cut rates, and we're now trading back to where we were as if the Fed hadn't cut rates at all. So it's a pretty interesting dynamic and really suggesting your liquidity in the overnight market is fairly tight. One way you can also measure how tight liquidity is, one way to also measure how tight liquidity is by looking at SOFR minus the interest on reserve balances. This is also a fairly high reading right now. You can see it hasn't really gotten this high in the past many times, if ever. And then also you can measure it versus the effective funds rate at 19 basis points, also a very high reading, something we just haven't typically seen post-COVID. So again, there's lots of volatility in the overnight funding market, and that's because liquidity has really started to get deteriorated, and there's just not enough liquidity in that marketplace. And that's likely because we have the Treasury doing lots of bill issuance and lots of coupons, and it's not likely that that's going to change anytime soon. In fact, the more interesting thing that occurred on Friday that probably didn't get much attention in the world of social media is that the effective funds rate, which is the Fed measure, actually ticked higher again to 4.11%. And it's interesting because the day after the Fed cut, the overnight rate was 4.08%. And it doesn't sound like a big deal. 3 basis points certainly doesn't sound like a big deal. But when you consider that the number of times that the Fed funds rate has actually changed on its own is extremely rare. In fact, you could go back to way back into 2023, and you can see the only time the effective funds rate has changed was when the Fed cut rates. Outside of that, it never changed on its own. And right now, you're seeing 3 times since the Fed last cut rates in mid-September, you're seeing the effective funds rate shifting overnight on its own. And that's, again, another sign of liquidity constraints in the marketplace. Also, this coming week, you're going to get two more Treasury settlement dates on the 21st and on the 23rd. And what's really interesting is that we've seen an increase in the usage of the standing repo facility as a result since September 15th. And what's more interesting about that is that you'll notice that we've seen those increased usages specifically around big Treasury settlement dates. And so I don't think it's a coincidence that you saw standing repo facility usage increased on Treasury settlement dates 2 times this past week. And you saw that occur also towards the end of last month. And now this week we're going to have 2 more Treasury settlement dates. And so we're going to have to keep an eye out. And so I think that a sign of liquidity being drained or liquidity constraints coming on these settlement dates of the 21st and the 23rd you could really see liquidity tighten even more than where it's been. And again, we could probably prove that theory right or wrong by, again, checking our SOFR rates, but also by checking whether or not the standing repo facility is being used. And my guess would be is that if liquidity is as tight as I think it is, the standing repo facility, which really hasn't been used at all going back to 2021, is likely going to be used again when these 2 settlement dates come on Tuesday and Thursday. Again, another sign of liquidity in the marketplace really getting drawn out. And this liquidity stuff really matters a lot because I think it's having an impact on risk assets. In the member area, we kind of use proxies as risk assets, and Bitcoin obviously is one of those proxies. But also, you can look at other things like market breadth, the summation indexes, and things of that nature, which really suggest there is some struggling in the marketplace. Certainly, the RSP has been much weaker than what we've seen out of the S&P 500. We've also seen parts of the market really begin to fall apart. The regional banks have really declined pretty sharply. I think last week we talked about some of the private equity names which have really been struggling more recently. And I think that this is just a sign of a market that's having a really tough time keeping all the pieces together because there's just not enough liquidity to go around and to keep all the plates spinning at one time. I mean, Wingstop has certainly been one of the perennial favorites I've had in terms of using it as a liquidity gauge, and you can certainly see that has really kind of struggled for quite some time right now. And you've even seen it spill a little bit into the XLF, which is the financial sector. We haven't really seen Meta performing very well, and you can see what an important area of support Meta has been sitting on. So when we think about where we are right now, we have this expansion of volatility likely coming. We have lower levels of liquidity in the market. And then I guess if I were to touch on one other thing, it's very clear right now that dispersion readings are still very high, and we are going into earnings season. And so once we go into earnings season, dispersion trades are going to start coming off, and that should then in turn begin to push correlations higher. And typically when you get to a point where dispersion minus correlations are beginning to decline, that's when you start to see the market really kind of struggle as well. So I think that's something we can keep an eye on going forward. And then I thought it was really interesting as well because we have this VIX, we have this skew divided by the VIX index, which I think is a very interesting measure. Basically what I'm trying to do here is looking at skew, which is a measure of tail risk, and the VIX, which is really more of a measure of shorter dated, at the money implied volatility levels in the S&P. And what this is showing you pretty clearly is that whenever you start seeing the skew divided by the VIX begin to decline, you see a major market reversal develop. You saw the same thing happen going into COVID. You saw the same thing happening going into the fall of 2008. You saw the same thing happening during this blow-off top in 2018. You certainly saw the same thing happening going into 2021, 2022. We saw a little bit of it going into this. We saw a little bit of it in this March and April of 24 timeframe. We saw it very clearly in this period of time here in December and February of 25. And now we're seeing the same thing also happening here. The question is obviously how much further is this going to fall and what kind of pattern is it going to resemble? Is it going to be something more longer term like this, or is it going to be something more short-lived like what we saw here, which is going to be more of a mild dip? Given where some of these dispersion and correlation readings are and how high the spread is between constituent volatility and the volatility of the S&P 500, my guess would be is that there's going to probably be a big reset that needs to take shape first. And I think that's going to potentially mean that we're going to have a rough period of time coming in the next over the next several weeks. Anyway, have a great weekend, and we'll see you again as soon as I can get all my computers working. Take care. Bye.